Yes, so let's come back. So we were talking about the major recommendations of FSLRC, and now we will be talking about the capital controls under that. So this is lecture 24 of this particular course, Indian Economy, Some Contemporary Perspective, and we are talking about financial sector reforms. So the readings remain same, the economic survey and article of Patnaik and Shah that I have mentioned. So the readings will remain the same like last lecture. So here it mentions about the, so we were talking about the capital controls. So under capital controls, the Indian Financial Code has also looked into the perspective of cross border inflow and outflow of capital, because we have been part of the global task force that is called Financial Action Task Force, and this task force has 200 members, 200 countries signing on this agreement, saying that how they can avoid the financial flows to certain activities which are dangerous to human existence, for example terrorism and all. So it has been there, and this FATF force has also given instructions to all the central banks, all the financial authorities across globe to monitor the movement of capital for the sensitive activities. Then we also have the Prevention of Money Laundering Act. It was passed in 2002 but implemented in 2005, and then there are subsequent changes. In 2012 also there were some changes, and in 2019 also some changes were suggested, but this particular act helps the government in terms of taking actions on any illegal flow of money or any financial fraud that happens. So IFC also puts a check on this, that when we are talking about the inflow and outflow of capital, then we should also be putting a check. There should be a regulatory body to check on the inflow and outflow. Restrictions on foreign direct investment which are motivated by either political motives and national security concerns. For example, due to our geopolitical developments with China and even Pakistan, we have a certain regulations put on check from investment coming from Chinese companies into the Indian equity market in the form of either portfolio investment, or if it is more than 10%, then it becomes FDI. So if we have that kind of regulations, if we have that kind of flow of capital, then how we can safeguard. So if the foreign capital is having some kind of national security concerns, then this IFC has a complete I would say strategies to deal with. It also talks about cross border financial flows. It is directly linked to the capital account openness, which means that we have already discussed the Tarapur 1 committee and then Tarapur 2 2006 report. In Tarapur 2, it was also recommended that until unless we have a stable macroeconomic fundamentals, then only we will be going for implementation of such schemes of capital account openness, because it will have adverse impact on the not only domestic currency but also in terms of financial stability. So rupee value may become quite volatile, and it will be very difficult for the central bank to control. So since capital account openness is not fully materialized in case of India, so it is left to the discussion for the, and it has some kind of future policy direction. So in case in future if we are going to have the capital account openness, capital account convertibility, then of course at that time there are scope for certain amendments in the IFC recommendations. But one good thing is that IFC recommendation is so detailed that it takes into account the cross border flows. And if you remember, we had the foreign investment committee that has recommended such type of measures, and that's why it is important to discuss here. Then one subcomponent of the FSLRC commission is also about the monetary policy, because this monetary policy is important because in this setup what is more important, that instead of only targeting inflation, if the low inflation is the only objective, then in some cases what we find that a central bank is not able to achieve certain objectives, and that's why it is required that there should be a particular direction given to the central bank to focus on the monetary policy perspective. So there is some kind of independence required for the central bank to keep in mind. But for the first time under IFC, so this is the conventional wisdom that we should have more freedom to the or we should give more freedom to the central bank. But under IFC, it was recommended that finance ministry will come into picture, and finance ministry will decide about the objectives, and it will pass on to the RBI, and RBI or the central bank will be following that, and banks will have the independence in terms of implementing these objectives. The decisions about the repo and reverse repo will be completely taken by the Monetary Policy Committee. So, based on the FSLRC recommendations, we have Monetary Policy Committee. Right now, the members are Dr. Ashima Goyal, Professor IGEDR. Then we have Shashank Bhide from the NCAER. And then we have Jayant Verma from Indian Institute of Management, IIM Ahmedabad. So, Indian Institute of Management, Ahmedabad, IIM Ahmedabad, we have Jayant Verma. So, these three members are nominated by the Finance Ministry, and or you can say from the government, and then we have the governor, deputy governor, and some other members from the RBI side, and they decide about the repo rate or the reverse repo rate cut that we see always. So, repo rate cut is basically now has become part of the Monetary Policy Committee. So, there is a controversy about this, that whether we should go for such type of composition where there is a say of the government also. So, you have a for or against views on this. So, for says that since the government becomes answerable when we have a higher inflation and central bank is quite reluctant in reducing the rate of interest. So, it is always better that there should be some coordination, and the against view is that if we are going for giving more power to the Monetary Policy Committee, which means that the government is dictating in the jurisdiction of RBI and the central bank, and it is always better that central bank should be given complete freedom in terms of tackling the inflation, so that there will be a special discretionary power for the central bank to act against any kind of untoward events due to rise in general prices. So, this particular dimension is always debated and discussed. You may be going through the opinions published in leading dailies, and these opinions are often having either for or against views. So, IFC has given this recommendation, and I think that is why Monetary Policy Committee came into existence. So, this is what, and then we have the public debt management. Public debt management is one area where we feel that the government is also having very difficult time. So, since we have the fragmented structure, and this fragmented structure sometime does not allow the government to efficiently look for the borrowing, efficient borrowing, which means that the low cost borrowing, or even in terms of management of the debt. So, IFC recommends that there should be a public debt management agency, and this agency will synthesize the information coming from the central bank, from the government ministries, and it will try to bring one cohesive directions for the public debt management, so that if the government is in need of money and if they want to borrow, then they can simply go and borrow from the different sources. So, this particular public debt management is also going to take into account whatever onshore and offshore borrowing happen between government and the external agencies. Then we have the development and redistribution. This particular task, for the first time the FSLRC has given such a unique recommendation. It is about the missing markets. Missing markets in the sense that since independence, since we have gone for promotion of the government sector heavily, so there is a lot of faith on the government sector, and even individuals, they do not bother so much about the investing, and that is why we have the well development government bond market, and even the institutions are are having some kind of obligations to invest some amount of money. So it is mandatory for those institutions to invest, and that's why it has become like one of the well diversified market. But this is not the case for the for example corporate bond market, because people have limited faith. There is a issue of disappearance, which means that after some years firms have completely gone missing, and it has become really difficult to trace, and that's why the people have very low faith, low regard to the corporate bond market, and that's why even institutions are not empowered so much to invest in that. So under IFC there is a particular dimension to develop those missing markets and create some kind of level playing field for both corporate plus the public sector industry. So IFC empowers the finance ministry as a nodal agency to implement and enact the market development schemes, which means that the subcomponents of the either missing markets, as I gave you the example of corporate bond market, finance ministry will look after. Finance ministry will also collect the data and make it available in public domain after every 3 years, which means that if you have a if the government has taken any initiative with regard to development of particular market, then finance ministry will have some kind of information collection, so that it can be further analyzed and further recommendation can be provided. Financial regulatory authorities will be tasked to implement these schemes and will be accountable to Ministry of Finance. So it means that this particular regulatory authority will be given some kind of responsibilities in terms of implementing these schemes. So for example, we have a national savings certificate. So post office takes care the investment in that particular instrument. In the same way, for the development of the private sector bond market or the private sector bond placement, there will be some agency, designated nodal agency, and this will be reporting to Ministry of Finance. Then we have the last it is called contracts trading and market abuse, and this contract trading and market abuse becomes really important to understand. And in this process, one of the important things is that once we go for enactment of or introduction of any policy, any regulation, there must be some kind of clarity. There should not be any overlap. So in case of India, in some cases it has happened that there is a there is a launch of a product which looks similar to the jurisdiction of the SEBI, and then we have Insurance Regulatory Development Authority, and then you have the confusion that which regulatory body should regulate the product, and as a result there is some confusion with regard to whether it should go to the SEBI or it should go to the IRDA. So in India we have the RBI, we have the SEBI, we have the Insurance Regulatory and Development Authority IRDA, then we have the Pension Fund Regulatory and Development Authority PFRDA, then we have the Forward Market Commission. Under Forward Market Commissions, we had commodity derivatives, but now it had moved to SEBI. So these are the regulatory institutions which take into account the banking system, stock market, insurance product, then pension fund, and Forward Market Commission that is dealing with the other industries under the Ministry of Consumer Affairs. So here, if these are the regulatory bodies, then what should be the form of contract enforcement, or if there is any kind of event of market abuse, which means that there is a dominance of one particular firm on the over all other firms, then how these institutions will react. So this talks about that. So under IFC, under Indian Financial Code, so the recommendation is that RBI will have the complete jurisdiction in conducting the monetary policy. So the monetary policy should go to the RBI completely. Banking regulations, consumer protection, microprudential laws, and the regulation of the payment system. So all these are part of the RBI. And there is a recommendation to create a unified financial agency Unified Financial Agency will take over SEBI, IRDA, PFRDA and the Forward Market Commission, and this Unified Financial Agency will have the coverage of stock market, insurance, pension plus the other products under Forward Market Commission. So now, as per the IFC, since it creates a lot of confusion, there is difficulty in maintaining the arm length distance among these SEBI, IRDA, PFRDA and FMC. So these institutions will be merged into one, which will be called as Unified Regulatory Authority UFA, and UFA will monitor the consumer protection, macroprudential laws except banking and payments, because banking and payments are part of the RBI. So RBI is now as per the IFC, RBI takes care of the consumer protection. UFA will also have the authority to monitor the organized financial trading of the RBI. Organized financial trading, which means that the trading of bonds, which we have the gilt security market, which means that open market operations, whatever securities are being transacted, it will be taken care by the UFA. Even in case of forex market exposures, UFA will then have full regulatory control on equities, government bonds, currencies, commodities and the corporate bonds, which means that IFC is now it is giving you the complete idea about where to and how we can go about it. The Securities Appellate Tribunal will be merged into the Financial Sector Appellate Tribunal. So as of now, we have the Insolvency and Bankruptcy Code. Under that, we have the Company Law of Appellate Tribunal. Now here in this case, it recommends to have the Financial Sector Appellate Tribunal, and FSAT will hear appeals of regulatory actions of the RBI, appeals of UFA, appeals of financial redress agencies. So there is now going to be ombudsman on all the regulatory bodies, so UFA and the central bank under IFC, and this FSAT will take care the concerns of RBI, then it also takes care of the concerns of UFA. It will also take care of the concerns of financial redress agency that we have already discussed, and appeal of some implement of the work of the Resolution Corporation. So the Resolution Corporation, which we talked earlier, that how this particular institution is going to be playing a role. Deposit Insurance and Credit Guarantee Corporation will become part of the Resolution Corporation, which means that if any investor is feeling cheated, or if the investor is not been given the due process in terms of settling of the contract, then this so the Deposit Insurance and Credit Guarantee schemes, it basically takes care that if you have deposited your money in the bank, and in the event of the failure of the bank, there will be some insurance attached and you will be paid. So in India, it is around 1000 rupees. So whatever is the amount, if the bank fails, you will be getting that money. The FRA will provide consumers a single venue to lodge complaints against all financial firms. So this is going to be one area where it is important. Public Debt Management Agency will act as a government investment banker and cash manager, which means that these particular institutions will unify the whole lot of borrowing or the debt management scheme, so that in the event when the government is willing to borrow money, it will give sufficient options or provide sufficient routes so that it can be processed quickly. The role of FSDC will exist with its function and statutory framework, especially dealing with systemic risk. So which means that since FSDC is going to be important for maintaining the systemic risk in the country, so this particular agency will play an important role in this. Now let us talk about the Financial Stability and Development Council. So each and every country, if you search in the UK and even in US, have the FRA, Financial Regulatory Authority. In the same way, after 2007-8 global financial crisis, now you have certain developments in each and every country where the central bank and the Ministry of Finance and government have been instructed to set up some authorities wherein if they have any adverse situation, then they can take certain measures and reduce the impact of any external shock, or even arising from the, or even arising internally if we have internal shocks arising. For example, we had the Indian banking crisis in 2016, and that was quite a lot, and even in 2018, September 2018, we had the IL&FS crisis that also had created a complete doldrum in the minds of the regulators and investors. And then we have the PMC saga in Mumbai, that has also deteriorated the confidence or sentiment of keeping money in the banks in the country. So, in 2010, and just to mention, if you go on the RBI website, then you find that there you have the financial stability report. So, it is called FSR, and after 2007-8 global financial crisis, this the central bank is now been given task that they have to bring out after every 6 months one report, and that will give us the idea that what is the financial health of the banks operating. So, this particular report gives you complete idea about the banking system, how and to what extent the banks are facing problem, or if they are good, then to what extent they are good, what are the good scenarios, bad scenario. There are certain methodology they discuss, stress testing and all. So, those are regulatory those are regular activities that are supposed to be done by the central bank, and now because of the 2007-8 global financial crisis, it has become the core acts of the central bank. Now, if you try and discuss the Financial Stability and Development Councils, then FSDC, it is a non-statutory regulatory body in the Ministry of Finance, and the Finance Minister is the chairperson of the FSDC. RBI governor and members are the RBI governor. Then here you have the chairman SEBI, then heads of PFRDA, Pension Fund Regulatory Development Authority, Insurance Regulatory Development Authority, Finance Secretary, Secretaries of Department of Economic Affairs and the Department of Financial Services, and Chief Economic Advisor. So, in FSDC, Chief Economic Advisor is also one member. In 2018, FSDC also included the Ministry of State responsible for Department of Economic Affairs, so DEA. So, now we have one more addition. Secretary of Department of Electronics and Information Technology, because now we have the collection of information, database management, and how this database management will be put into completely in safety norms, and how it can be accessed, which all authorities will have the access to that crucial data. So, to keep that in mind, Secretary of Department of Electronics and Information Technology is also part of. Now, we have one more new agency in India right now. So, we have now Insolvency and Bankruptcy Board of India, IBBI, and it was set up in 2016 on October 1. So, this particular chairman is also, because this particular body has been set up to take care the corporate insolvency resolution process, and it has been quite a success, because earlier we did not have such type of institution to tackle with. So, even firms which were making losses, they had no idea when they can approach and where to approach. So, IBBI is a particular body interested or has been given task to look after the bankruptcy and the insolvency cases in India, and it comes under Insolvency and Bankruptcy Act, and that is why this FSDC becomes really important, because it talks about the systemic risk that we are talking about. Now, going ahead, I will be talking about how we can go for further, I would say, design and development, and then we will be spending more time now after this. So, we have discussed the FSLRC Commission. So, under FSLRC Commission, one good thing has happened. So, now it is time to recap a bit. So, in this particular session, we have covered almost all the subcomponent of the FSLRC Commission. We have also discussed in detail that how detailed is the FSLRC recommendation, or to what extent we can understand the role. And in the beginning, when we were talking about the the banking sector reforms, then our focus was just to have the banking sector and how we can regulate and how government can give certain targets and how those targets can be made by the banks. Then came the era of 1980s. We were still not doing good. At that time, we also had to go for nationalization. Then we had the 1991 period where we had gone for the economic liberalization, and economic liberalization gave the boost to the financial sector, and then we had to open our economy, and then services sector boom started, and this services sector boom led to the creation of the new middle class, the emerging middle class, and that created a demand for lot of financial products, and these financial products again gave boost to the financial sector as a whole. So, we had to go for expansion of our equity market. We also developed our foreign exchange market. We also had the commodity market. We also now have the trading in almost all spheres except REITs. I think REITs are not now, real estate investment trusts are not part of. Then we had the fund management businesses flourishing because we have the now mutual fund business is leading over all other sectors. Then we had the non-banking financial companies taking over, and they have also provided sufficient liquidity to the financial system. So, now we are in the situation where we have to look for not only the expansion of the sector, but we also have to look for certain benchmarks, certain rules and regulations through which we can monitor these institutions continuously. And since the sector has expanded so much that there is a risk of contagion, that if you have something happening in US, and because of that if you have a spillover coming to India, then it will have a negative impact, and certain firms and those institutions which are directly linked to the US market may be adversely impacted. So, to keep that in mind, for the first time this FSSRC report had recommended the Indian Financial Code, and under Indian Financial Code we had the whole lot of regulatory frameworks and also to how to deal with the adverse situations. One of the reasons why I discussed that committee report so extensively, that for the first time we had gone for such a type of recommendation, and some recommendations are already implemented, some are under process. If you go on the RBI or if you go to the Ministry of Finance website, then you will find that this particular commission report is being mentioned separately with certain changes. There are formation, reformation of certain committees to look after. So, it is expected that going ahead in 5 to 10 years we will have some recommendation picked up from this particular committee's report, and it may become part of the main regulatory structure that we have in India right now. So, now after this we will be now talking about the Indian banking crisis, that what led to the Indian banking crisis, what were the regions. So, in a few minutes or so we will start that session, and then we will be having the clear cut idea about that what were the regions for the Indian banking crisis. Thank you so much.